Today, we're diving deep into the fascinating world of investment psychology. Have you ever wondered why? Despite having a well-thought-out strategy, your emotions sometimes get the best of you when making investment decisions? Well, you're not alone. In this video, we're going to unravel the intriguing clash between emotions and strategy when it comes to investing. But before we embark on this enlightening journey, do me a favor. Hit that subscribe button and ring the notification bell so you won't miss any of our future insights on finance and investing. Your support means a lot to us. Now, let's get started. Number 7. Setting clear goals and investment plans. Setting clear goals and creating a well-defined investment plan is your roadmap to success in the world of investing. Just like embarking on a cross-country road trip, having a destination and a route in mind can make all the difference. Your investment goals should be specific, measurable, achievable, relevant, and time-bound. The SMART criteria. Whether your goal is to retire comfortably, buy a home, or fund your child's education, articulating it clearly is the first step. It's like plotting your destination on a map. Once you have your goals in place, it's time to create an investment plan that aligns with them. This plan should outline your asset allocation, risk tolerance, and investment horizon. It's like plotting the stops along your journey, deciding where to refuel, rest, and explore. By connecting your investments directly to your goals, you can stay focused on the big picture. Market volatility and short-term fluctuations become less daunting when you're guided by a long-term plan. It's like having a compass that always points you in the right direction, even when you encounter unexpected twists and turns. Number 6. Education and research. Education and research are the foundations of informed decision-making in the world of investing. The more you know, the better equipped you are to navigate the complex and ever-changing landscape of financial markets. Imagine you're about to embark on a cross-country journey. You wouldn't blindly set off without a map, GPS, or knowledge of the terrain, right? Similarly, in investing, acquiring knowledge is like having a GPS that guides you through the market. Expanding your financial literacy can be a game changer. Understanding investment strategies, market dynamics, and risk management techniques empowers you to make more informed choices. It's like upgrading from a basic compass to a high-tech GPS system. One essential aspect of research is conducting due diligence before making any investment decisions. This means thoroughly investigating potential investments, understanding their fundamentals, and assessing their risk-reward profiles. Think of it as conducting a thorough background check before hiring someone for a critical role. In today's digital age, there's a wealth of information at your fingertips. Online resources, financial news outlets, and reputable investment platforms can provide valuable insights. Don't forget to leverage these tools to enhance your knowledge and make well-informed investment choices. Number 5. Awareness and self-control. Awareness and self-control are your secret weapons in the battle against emotional investing. Recognizing the emotional roller coaster that accompanies investing is the first step towards mastering your emotion. When you feel fear or greed creeping in, it's like encountering a wild animal in the forest. You don't want to provoke it. Instead, you want to remain calm and composed. Take a deep breath and remind yourself of your long-term investment strategy. One practical technique to cultivate self-control is to implement a waiting period for significant investment decisions. When you feel the urge to buy or sell impulsively, give yourself a predetermined time frame, like 24 hours or a week, to reconsider. It's like having a cooling-off period before making a big purchase. Another helpful strategy is to keep a journal of your investment decisions and the emotions you experienced at the time. This journal can serve as a valuable tool for self-reflection and improvement. It's like keeping a diary of your encounters with the emotional beast, helping you learn from past experiences. Number 4. Herd mentality. Herd mentality is a fascinating yet dangerous psychological phenomenon in the world of investing. It's when individuals tend to follow the crowd rather than making independent decisions based on analysis and research. Imagine this scenario. You're at a party, and everyone is raving about a particular stock that's been soaring. FOMO, fear of missing out, kicks in, and you decide to invest without conducting your own due diligence. It's like buying a trendy fashion item just because everyone else is wearing it without considering whether it suits your style or needs. Herd mentality often leads to impulsive actions, driven by social proof rather than careful analysis. When the crowd is euphoric, it's easy to get swept up in the excitement. But just as quickly as the crowd can inflate a bubble, it can burst it. The danger here is that the crowd may not always be right. It's crucial to remember that what's popular in the short term may not be a sound long-term investment. To counter herd mentality, take a step back. Evaluate investments objectively and stick to your well-thought-out strategy, even if it means going against the grain. Number 3. Confirmation bias. Confirmation bias is like having blinders on when you're researching investments. It's a cognitive bias that leads us to seek out information that confirms our existing beliefs while ignoring or dismissing contradictory evidence. This bias can be a significant roadblock to making rational investment decisions. Imagine you've done some initial research on a stock and you're excited about its potential. Confirmation bias might lead you to only pay attention to articles, news, or opinions that support your positive view of the stock. It's like tuning your radio to a single station that only plays your favorite song, even though there might be better songs on other channels. This tunnel vision can result in a skewed perception of reality. You might think the investment is a surefire winner when, in reality, you've missed critical information that could change your perspective. It's akin to trying to put together a jigsaw puzzle with missing pieces. You won't get the whole picture. To counter confirmation bias, actively seek out information that challenges your beliefs. Diversify your sources of information and remain open to different viewpoints. Think of it as broadening your musical horizons to discover new tunes you might enjoy. Number 2. Loss aversion. Loss aversion is a psychological quirk that causes us to feel the agony of financial losses more acutely than the pleasure of gains. Research in behavioral economics has shown that losses can have twice the emotional impact as equivalent gain. This phenomenon can wreak havoc on your investment strategy. Imagine you're holding a stock that's been losing value. Loss aversion might make you hesitate to sell it, even when the rational choice is to cut your losses. You're essentially holding on to a sinking ship, hoping it will miraculously turn into a yacht. It's like having a garage full of old, broken appliances that you can't bear to throw away because you remember how much you spent on them. This emotional attachment to losing investments can lead to what's known as the sunk cost fallacy. It's when you throw good money after bad, trying to recoup your losses instead of making objective decisions based on the current situation. Before we reveal number 1, please consider subscribing to the channel and hitting that like button if you've gotten any value so far. And to add more value to our dear viewers, we've added some links in the description below to help you to start investing like a pro. Number 1. Fear and greed. Fear and greed are the twin specters that haunt the world of investment. These emotions, deeply ingrained in our psyche, have the power to shape our financial destinies. Fear often rears its head when the markets take a nosedive. The prospect of losing hard-earned money can be paralyzing. This fear can lead to irrational decisions like panic selling. Research shows that during market downturns, individual investors tend to sell their stocks at precisely the wrong moment, locking in losses. This is akin to jumping out of an airplane with a parachute that opens on its own, but only after you've plummeted a few thousand feet. On the other side of the emotional spectrum, we have greed. Greed can be a sly, seductive temptress that lures us into high-risk, high-reward investments without due diligence. Studies have demonstrated that when the market is soaring, investors often flock to stocks that have already seen substantial gains, thinking they'll ride the wave to even greater riches. It's like chasing a rainbow, hoping to find that pot of gold at the end, only to realize it's an illusion. The psychology of investing is a fascinating subject that reveals how emotions can significantly impact our financial decisions. But remember, investing is a journey, not a sprint. It requires a balanced approach, combining rational analysis with emotional discipline. By recognizing the role of emotions, educating yourself, setting clear goals, and seeking professional advice when needed, you can navigate the investment landscape with a greater level of objectivity and make decisions that help you achieve your long-term financial goal. But in order to get your wealth to the next level, you need to adopt the millionaire mindset. If you want to learn more about the mind hacks millionaires use to get ahead, Then check out this video where we break down 20 mind hacks that can elevate your financial game instantly.